So years ago, lots of people were using a lot of deductions and avoiding a lot of income tax. And so the IRS developed this alternative minimum tax to help mitigate that problem. And basically what it is, it's a whole nother tax system besides the one we've been studying so far. And there's what they call adjustments and preferences to your income tax that we've already calculated. And you have to either add or subtract these preference or adjustment items to come up with a new number, a new taxable number, and you calculate a tax based on that number. And you compare this tax, your alternative minimum tax, to your regular income tax. And whichever, if it's higher, then you have to pay the difference. So if your regular tax was $5,000, but your alternative minimum tax was $6,000, you would have to tack on $1,000 of alternative minimum tax to your regular tax. So you paid a total of $6,000. And so that's what they've done. The problem with it is they set the numbers at a fixed number. These numbers didn't adjust every year. And so recently, we have found more and more people becoming subject to the AMT. It originally started out, it's way up here and everybody's way down here. So not many people were subject to it except high income individuals who had a lot of deductions. But as you know, the price of houses went from a good house is $50,000 to a good house is $200,000. We're getting more and more interest in taxes that are getting closer and closer. So we're finding a lot more middle class people becoming subject to it. Now they are trying to rectify that by moving these numbers up to adjust with inflation every year. And so we're getting better at it. And so a lot of more people are not subject to it nowadays. So let's take a look at some of the rules related to the alternative minimum tax, often called AMT. All right, so the AMT, like we talked about, it's just a different tax system that ensures taxpayers don't use tax breaks to avoid taxes. So we start with our regular taxable income before exemptions. Now this is before 2018, so we don't have exemptions anymore. So it's just your regular taxable income and standard deduction plus or minus your preferences and adjustments equals your alt AMT taxable income less your AMT exemption equals your amount subject to AMT. Excuse me. You multiply that by your AMT tax rate equals your minimum tax minus that from your regular tax equals the amount of AMT due with the return if it's a positive amount. So this is exactly what I just said. We have your regular taxable income, we add or subtract our preferences, we multiply that by our AMT rate, and we get the alternative minimum tax. We see if it's higher than your regular tax, and if it is, you pay the difference there of AMT in addition to your regular tax. So this is where I was saying, if your AMT tax is $6,000, your regular tax is $5,000, your difference would be $1,000, and you'd have to tack that $1,000 onto your regular tax and pay it. So some of the adjustments you have to look at are, your standard deduction and your property and income taxes and depreciation. Depreciation is a big one because there's actually a whole nother table to calculate AMT depreciation on it. And what they do is they elongate the time period. So normally maybe this piece of machinery is depreciated out over 7 years. Well, for AMT purposes, it might be 10 years. NOLs, they're calculated differently, and state tax refunds are subtracted from your income. And so you just get a different taxable income. And so these are the big adjustments we see on here. And here you can see what your maximum AMT exemption amount is. So you can see it's getting kind of low. It's kind of low. I mean, $111,000 for a married filing joint is really just two couples earning about, $60,000 a year. That's not unheard of these days. Obviously, years ago, it was very uncommon, but you can see now we have some inflation adjustments, so hopefully numbers will get a little higher. I really think they should have made all of this stuff start to kick in about the $250,000 level for single and $500,000 for married filing jointly, because once you reach those thresholds, now you are getting the richer people who can afford these things. I mean, $71,000 for a single person's really not, doing that great. But anyway, you also have the phase out threshold. So this is your exemption here, but your exemption starts to phase out when you start hitting the higher income. So you even start losing to this subtraction here. If you remember, we have this, we look at the phase out or excuse me, we look at the exemption. And so when we get our alternative minimum tax, then we subtract our exemption, and then that's the amount that's going to be subject to AMT, and that's what we multiply by our tax rate. And so that's what we're looking at here. This is the exemption amount. So you only get to subtract $111,000 if you're married filing jointly, and that gets phased out over a huge range. I mean, from $100,000 to $1 million is a huge range for this phase out to be phased out over. God, that's a lot of saying phase out a lot. Anyway, so here's your exemption, here's where it phases out, and then here's your tax rate. So it's 26% on income up to this amount, and then 28% on the amount over this amount. So the AMT is really a flat tax rate, with the exception of this little jog right here, but it's only a 2% difference. Again, I don't know why the IRS doesn't just make it one rate. Just said 27%, would have been a great job, but no, they got to make it complicated. So the AMT is a flat tax rate calculated on your income after you are disallowed or have to change a few things over here, and then you just compare it to what your regular income tax rate. If your AMT is higher, you subtract your regular income tax amount, and that difference is what you'll have to pay as AMT. So yeah, like I said, the AMT target, the exemption at 111,000 doesn't really seem to be targeting high income taxpayers. But what are you going to do? So we run into AMT a little bit here and there, not very often, because again, unless you live in some high tax states, like California and New York, where your income taxes might be extremely high, so you have a very high itemized deduction for your state and local taxes, that's where you can really start getting into some alternative minimum tax issues. But again, they're not really, I don't think taxpayers are, playing the system by deducting their state and local income taxes. It's not their fault they're in a high tax area. They're just deducting it like they're allowed to, and then the IRS comes along and says, no, we're going to change that rule too and take it away from you, so now you owe even more tax. Remember, whatever rule gives the IRS the more money, that's probably the right way to do it, and that's what they're doing here. They're just changing their rules because you were paying less money and they didn't like it, so they changed the rules a little bit. But anyway, next we're going to talk about the self-employment tax. We've talked about this briefly before. This is a really hard one for a lot of self-employed people to prepare for, and so it's important that you learn about it so you can plan on it when you become self-employed.